Hi, I'm Ed Fulbright, CPA, CGMA, PFS of Fulbright Financial Consulting, PA. We would like to welcome you to our educational briefing.
Shares in U.S. stocks rocketed 7.2% higher in the third quarter. It was the best quarter in 5 years, and shares settled near the record high. But the 9-year-old bull market is the longest in modern U.S. history, and the expansion is the second longest on record. How long can this go on? What's driving stocks? Earnings are driving stocks. The S&P 500 profit expectations surged in the first 8 months of 2018, contrary to their normal pattern. Earnings estimates by Wall Street analysts for 6 years in a row, from 2012 to 2017, started out overly optimistic and then gradually were shaved back as the end of each year approached. That pattern was nothing like what's been happening lately. Since the beginning of 2018, when the new federal tax law came into effect, analysts did not lower their expectations. To the contrary, earnings estimates surged for 2018 and 2019. The initial surge in the first few months of 2018 was expected. Analysts had to factor the tax breaks into their earnings forecasts, and it would be a one-time adjustment. But earnings forecasts continue to brighten, accelerating in April through August 2018, beyond the one-time upward revision that had been expected to follow the introduction of a new tax code. That was an unexpected surprise. Sales revenue estimates generally showed the same pattern as profit estimates in recent years. Wall Street's expectations for sales were shaved back materially as the end of each year closed in. But in 2018 and 2019, the pattern was broken. Revenue estimates for America's largest public companies accelerated sharply. Unlike corporate profits, accelerating sales estimates are not driven by taxes or accounting. Sales are driven by consumers. The accelerating rate of expected sales revenue is a sign of unexpected consumer strength. Consumers account for about 70% of the annual rate of U.S. growth, making this a key fundamental sign of momentum. Meanwhile, in another sign of growing economic strength ahead, the Federal Reserve's Federal Open Market Committee revised upward its quarterly median forecast for growth in 2018. From a June projection for 2.8% growth in 2018, central bankers boosted their expectations for growth to 3.1%. It was the fourth consecutive quarterly revision upward for growth by the Fed. In September 2017, the Fed expected the economy to grow 2.1% in 2018. Just a year later, they boosted expectations to 3.1%. With the economy performing better than expected, Fed Chair Jerome Powell affirmed the Fed's policy was on track. At a one-hour press conference, Mr. Powell said the Fed would not hike rates if inflation temporarily rises above the 2% target rate. Inflation is muted and likely to remain so, according to Fed forecasts. So, the central bank chairman is unlikely to raise rates aggressively and put the brakes on economic growth. The surge in earnings expectations is what's driving stock prices, and the sales revenue increases indicate unexpected underlying consumer strength, and inflation is not a problem. How long can the good times go on? No one knows, but they show no signs of ending as the fourth quarter of 2018 begins. We are independent advisors, and you can count on us for incisive analysis of issues affecting your wealth.
Thank you for listening. Please contact us with any questions, and also contact us if you're interested in our complimentary second opinion on your investments or to set up a meeting regarding your wealth. Don't hesitate to share this video with people who might benefit from our work. Thank you again, and have a great day.